5 minutes on that one.
Okay. Welcome. And so I'm Felix Salmon of Fusion, and I have the incredibly easy job of moderating some of the smartest people at the conference this year. So I intend to sort of sit back and do very little here and let these people, you know who they are. If you don't know who they are, you can Google them, or they're in your program or something like that. We have on my far right, Peter Budko of AR, Damien Lillicrab, Nouriel Rubini, Gene Sperling, Andrew Whitaker. That is the extent of the introductions, because we have much more interesting stuff to talk about. The name of the program is Disequilibrium in Global Debt. We have all unanimously decided we have no idea what that means. So if you don't know what it means, or if you do know what it means, can you please email me? I'm quite serious, actually, by the way. My email address is felix@fusion.net. That's felix@fusion.net. And one of the things which worked quite well yesterday, I'm going to try it again today, is asking people not to wait until the end if they have questions, because often the questions are germane to what we're talking about right now, but rather to just email me a question if you have one in real time. And I have my iPad here, and I will see the questions pop up, and then I can ask them with your name, and we can get answers, and we can make this a little bit more of a group discussion rather than, 6 middle-aged white guys all talking to each other. So I apologize on behalf of Milken for the lack of any females on this panel.
I'm happy just to be called middle-aged at this point.
So yes, all questions welcomed, felix@fusion.net, and really you can talk about anything debt related because none of us know what disequilibrium means. But I'm going to start with Damien because he's awesome value about this. And I'm going to ask a simple question to start off with, I think, which is how much debt is too much debt? And do we have, in the world right now, there's $58 trillion of US credit alone, and God knows how much sovereign and stuff on top of that. Have we got too much debt in the world?
My perspective is yes, that we do have too much debt. Prior to what we call the GFC, the global financial crisis, we had lots of debates and discussions around my work about could debt go on forever? At that stage, debt in the US had grown from total debt used to be about 150% of GDP from about the 1940s or so through till about 1987. So we'll call that Greenspan type thing. And then from there, it went from 150% of GDP up to about 360. So to me, it didn't seem like that was sustainable. People were arguing that it could go on. And I think that the collapse in house prices that we saw there was a sign that there was at least too much debt in that area. And I think that what we did then was shared it around a bit in terms of picking some up from the government. So we've got more debt now.
So does it need to come down?
Look, I think so. I think that my big picture view is that we've been juicing the global economy for 20 years and really hoping that things would get better. So we've been juicing that by lots of debt or pulling forward growth in China, overbuilding there. So doing a range of things, QE, so all of these things are stimulus and trying to get more and more GDP. I think in GDP we trust type thing. And I think that path seems unsustainable. Like the fact that, after 20 years, we're still trying to juice things maybe means that we're trying for something which just isn't going to come. And so my sort of thinking is that maybe we should think about a bit of a plan B.
So, Nouriel, you have this idea, it is coming down, right? Because you can more or less ignore all of one way to bring the debt down is for central banks to just monetize it and buy it back. So so all of those QE operations around the world, they don't really count, right, in terms of total debt stock, or do they?
They don't count. I mean, if I talk about that, first of all, I would say we have to not generalize. We have to think that somebody's debt is somebody else's asset. So when you sum together the debt of government, household, corporates, financial system, you're a bit doing of a double counting, and you have to consider also the assets of the economy, capital stock, not just the debt. So I think the gross number can be a bit of a misrepresentation. Secondly, yes, this point about debt monetization is important, I'd say, in 2 dimensions. I mean, take Japan. Government debt as a share of GDP officially is 250. Looks like totally unsustainable, right? Greater than Greece. And guess what? JGB's bond yields are still, what, 30 basis points 10-year, going towards zero. So what's going on? First of all, they have a lot of assets, foreign assets, like central bank. You net out that number is 170% of GDP, not 250. Third observation, they're monetizing the debt. Right now, the BOJ owns about 25% of that debt. Based on the current pattern, they're going to own 40% of that debt. 40% of 250 is 100% of GDP. That's zero interest rate liabilities of the government. They're not going to have to pay interest nor principal back ever. So that 170 number minus 100 becomes 70% of GDP. Suddenly it looks like more sustainable. Second element of it, debt ratios are still high, even if in some countries stabilizing or falling, but debt servicing ratios in the US, for example, right now, for households, but also for part of the economy, the government, are at all-time historical low. Why? We have zero policy rates, and we have long-term interest rates, say, 10-year treasury at 2%, and in $3 trillion or $4 trillion equivalent of government bonds in the Eurozone, in the rest of Europe and Japan, now we have negative nominal yields. So both on the short end and the long end of the curve, debt servicing payments are much lower than they used to be, and therefore this debt ratio for the time being are sustainable. Of course, if policy rates were to normalize, if long rates were to go much higher, eventually we'll have less distress. But I would say looking at the gross number kind of hides a lot of nuances that are important to figure out.
Gene, is he right about this? If one man's debt is another man's asset, do they just kind of balance out, and or should we be worried about the amount of fragility that is generally associated with large debt stocks?
Well, I agree with Nouriel in that I think it's hard to generalize, and you have to look in particular context. So for example, in the United States right now, I agree things are in some ways look more stable debt-wise than usual. If you look at state and local debt, it's, I think, the lowest as percentage of GDP since probably 2003. I think financial debt's probably the lowest since 2000. The federal debt, private sector and nonprofit debt is relatively low. As Nouriel said, the debt service. So when you look there, I'd say that we've have deleveraged some and that things are a bit more stable. Now, should that, is that all great? Well, I think part of it is it's hard to look at a snapshot. So for example, I think what has been missing in both the European and the United States fiscal policy is an ability to do single fiscal packages where you can at the same time actually drive up the debt for more stimulative spending, but within the same package where you're doing longer term reforms, or fiscal reforms. So in this case, I always say you don't get any, like in the United States, I would say you don't get any fiscal credit for deferring deferred maintenance. It's not. I mean, if you have bridges that have to be fixed at some time in the next several years, they have to be fixed. Broken windows in school buildings that have to be fixed. Just like in your house, if you have a broken pipe in the basement, you don't get fiscal credit for not doing those. So in that case, you could say, well, if we just had a major infrastructure initiative and we did some borrowing, and it was to do deferred maintenance, that would be much better for the fiscal for the economy, for jobs, for demand, for growth. That would help. Now, you could say that if you just did that, you would take back some of that advantage because people would worry that you're going to be Greece. But if in that same package you were doing fiscal reforms that gave people more confidence you were going to deal with revenue entitlement challenges, then I think that is I think in many ways the missing package that we've seen from the global economy. So I think when you talk about debt, if you just do it in a snapshot, you need to look at it in the context of what actually makes sense. And the failure of fiscal policy in this context has put this enormous burden on our central banks, have made them the saviors of last resorts. And I admire everything Draghi, Bernanke, and Yellen are doing, but they are in some ways stepping in for a failure of fiscal policy and an inability to have this kind of compact where you realize that you should at times want debt to be higher, but perhaps in the same package where you're giving people more comfort about the long-term debt.
So I just want to concentrate a little bit on this comfort about the long term that you're talking about, and you talk a little bit about entitlement reforms and so on and so forth. Without going into the details of fiscal policy, what is it that people are worried about in terms of there being too much debt? Is that a rational worry, and how much debt does there need to be in order for that worry to be rational?
Well, I'm going to let Nouriel and others talk a little on the global side. I think that there is a lot to be said for the sustainability. If you look at a company or a country and their debt is going up high and it's gone on a trend upwards, that is worrisome. On the other hand, so I think there's a reason why
is it worrying? What's worrying about that?
Well, because it looks like it is out of control. Yeah. But if your debt is, if I tell you that a company has a certain amount of debt and you said, is that too much? You'd say, well, I don't know, is it Apple's debt? Or is it someone else's debt? You wouldn't be able to make a judgment on whether it was too much debt unless you knew the profile of what their income was, what their prospects were. I don't think that's much different from a country. So I think it's not, I think that it's rational and smart for policy members like the United States to say we want deficits to be under 3% because that stabilizes the debt. And I think particularly in the United States, when people see it stable, they're looking more at other economic factors. So I think stability is probably, how stable the path is, I think, to me, in the United States, is probably more important than than the exact amount. And I think you just have to look at it in the fiscal cycle, too. And I think right now, my biggest worries about our economy and our workforce has to do with the fact that we had the worst recession since the Great Depression, but a relatively inadequate recovery to help deal with the amount of pain that was in the labor market. And I think you can't look at the debt equation without looking at the particular circumstances that you're in.
So, Peter, is Jean right? We don't need to look at the stock of debt so much as just the sort of overall direction of it, and because the rates are so low, it's easy to pay it all back and to service it, so there's nothing much to worry about.
I think we really need to make a distinction between good debt and bad debt. I'll use an example. I have 5 kids, 4 boys and a girl, and I teach them all you can be one of 2 things with your money: a consumer or an investor. Which one are you going to be? Are you going to be consumptive, or are you going to be productive? Now, again, I said 4 of them are boys in their 20s, so they're idiots, and you know which ones those are. But my daughter, completely different. She's an investor. That's good debt. If she were to borrow, she doesn't do this on a credit card, but to invest, that's not necessarily bad debt because she's being productive with that. We can apply that up the food chains, corporations. We deal with middle market companies and borrowings, and right now it's a relative dearth of financing in that space. And as we make credit decisions, we particularly look for the use of proceeds. What are they using proceeds for? What are they using the debt for?
Well, we know what they're using it for. They're using it for stock buybacks.
Well, stock paid, dividend recapitalizations. I love that euphemistic term, dividend recaps. No, it means money's going right back to the owners rather than in a productive use. We much prefer a productive use, growth, hiring, factories, all of that. Those are the types of borrowers where I think there's a sustainable level of debt. You've also got to look at the fact that there are 2 types of borrowers. You can't always look at the ability to repay. You've got to look at the willingness. And let's take that even further up the food chain. Let's take that to countries and look at willingness to repay. Greece, I don't know, they sort of like where they are right now. The country, the people like where they are right now. If we look at the U.S. economy, if we look at U.S. Borrowing as a % of GDP, we're at all-time highs since World War II, right? But after World War II, we paid that down over a period of 30 years to the 70s. We've built that right back up. The question is, what are our leaders going to do in the next 30 years? There's good purposes for bringing on debt. Certainly World War II and the building up of that, obviously that was a good use of borrowing.
Okay, so
the question is, do you pay it back?
We have good debt and we have bad debt and we have a mountain of, I don't know, call it $100 trillion of debt on the planet. What's the ratio? How much of that is good and how much of that is bad?
Well, I guess I saw some figures by an English politician whose name escapes me. He's a lord, Lord Adair, and I think he suggested that some very high percentage, like 90%, at least 70% or 90% of debt recently has been used to buy existing assets. So when we talk about infrastructure, I think everyone would like to see more infrastructure built, and that would seem to be something that's a good use of debt. What we're seeing at the moment is lots of these low interest rates causing asset prices to be really high. So I think, in terms of QE and one of the concerns about it, what it's doing is pushing down the returns on anything and pushing up the price of everything. So, I mean, we're a pension fund. Like we're trying to get long-term steady returns for our investors. And we've had fabulous returns the last few years, but that's a risk going forward. Where are the returns going to come from? So if you think about it, this is the income that you get on an asset and this is the price. What QE does is push the price up higher and higher for the same income. So I think in terms of is QE a risk, I think it is. Like you're getting this dislocation here between prices and income, and that's...
So it's a risk, especially for you, because you're a mark-to-market investor. And obviously, if you have interest rates of 0, and then at some point we wake up and the world is relatively normal and interest rates are, say, 2%, which doesn't sound very high to me, that's going to be mark-to-market losses of trillions and trillions of dollars across a whole bunch of mark-to-market investors. So is that a systemic worry? Could those losses cause some kind of nasty avalanche?
Well, I think, I think that could definitely happen. I think to take another side, we've been talking about the government side a fair amount. If you look at the corporate side, I think that there have been some lessons learned since 2007 to today, because although we are kind of late cycle in the credit cycle now, we're not near the peaks where we were in 2007. If you look at leverage is lower. If you look at leverage buyouts, the equity contributions are higher. If you look at interest coverage, it's much higher because the rates are a lot lower, but that also allows the companies to generate more cash that gives them a bigger cushion. If you look at maturities in 2007 when the crisis hit, there was a huge wall of maturities which caused a lot of problems. Right now, everybody who could finance has refinanced and has generally financed with longer maturities. One other big difference is covenants. In today's world, there's in the leveraged loan market, 2/3 of that market is covenant light, and so from the company's point of view, that's a good thing. Although, from the investor's point of view, that might not be such a fantastic thing. But as you talk about, you have to look also at the technical side, from the market side, because in today's world, the investment banks have, and the banks in general have very little inventory, and because of the way the regulations are set up, that's really going to impact liquidity. So that I think that this time around, when there is a liquidity crisis, you're going to see potentially much steeper drops in prices because no one's going to be stepping in to take the other side of that trade. And the other technical difference this time is the shadow banking piece of the equation is much bigger than it was last time, and that's an untested part. So we're not really sure how that would work in a crisis this time.
So those of you playing along in the Milken Conference drinking game, we've got bond market liquidity. You can take a drink on that. We're still waiting for big data, maybe. I don't know who's going to come up with that one. Nouriel, so talk to me about the risk that there's going to be a market, that the markets are going to sort of crater because we have illiquidity and because we have these big losses which could happen quite quickly. Is that a systemic risk in your view?
I was in Washington last weekend at the IMF meetings, and there was this debate on whether, say, Fed normalization is going to lead to what was referred to as a super taper tantrum, as opposed to the Yellen conundrum. One case having a spike in long-term interest rates, the other one, instead, long-term interest rates remaining low. I think that my view, and it's something of a consensus, is that a super tantrum is not going to occur. One, because it's not going to be a surprise. It's been telegraphed now for 2 years, while the tapering signal from Bernanke was a surprise. Secondly, the Fed is going to start later and more slowly, and therefore the impact is going to be more moderate. And finally, I would say that if there is a risk, actually, is that like in the previous cycle where we had long-term interest rates remaining low after the Fed hike, at that time, you remember, there was the bond market conundrum, the way Alan Greenspan was referring to it. And Ben Bernanke explained it as being driven by the global savings glut of the Chinese supply of saving, keeping long-term interest rates in the US low. They were not rising fast enough as the Fed was normalizing. This time around is going to be the Yellen conundrum. And why? Because we have this global now liquidity glut coming from the action of ECB, BOJ, and 20 other central banks in Europe and Japan and all over Asia. And today, even a 2% yield, crappy on a 10-year treasury, is 20 times more than 0.1 on bonds, and infinite more than the negative nominal yields on $3 or $4 trillion of bonds across Europe, Japan, and other parts of the world. So if anything, actually, this global liquidity glut is going to keep long-term interest rates in the US lower than otherwise, rather than causing a tantrum. So I would worry more about the consequences of long yields staying too low for too long, maybe creating over time, like in the previous cycle, where the long-term interest rates were too low and we had the housing bubble, a subprime bubble, a credit bubble, eventually equity bubble, credit and asset eventually went into a bust. I think the risks are actually that long rates remaining too low for too long after we normalize could create the condition for another cycle of releveraging that eventually from a boom and a bubble goes into a bust and a crash. But it's not the story for this year, maybe for 16, maybe for 17.
So Damien, Adair Turner's looking at debt dynamics, and he's saying, in principle, we really love what Peter's talking about. We love the idea that companies are going to borrow money and invest it in productive uses, and that's going to help boost GDP. In practice, the overwhelming amount of private sector borrowing is just people borrowing against increasingly expensive urban real estate, whether it's corporate or residential, commercial or residential, and there's nothing productive in that. So is that going to wind up inevitably causing this boom and bust that Nouriel's talking about?
Well, I think that Nouriel's sort of potential bust there is almost drowning in honey, isn't it? Like that's what the central banks only ever talk about, like this thing if growth comes and it's too strong and that sort of drowning in honey type thing. But I think that the bigger risk is not that interest rates go up and there's some taper tantrum. It's that earnings fall. Like if you look at real earnings over the last 50 years, for example, in the US, they've been very mean reverting and they've arguably never been higher. I mean, so there's just a chance of having a recession, and particularly when you've cut so many jobs, or I know jobs are out there, but there's just a chance of having a recession. So if earnings don't come, I think the risk is that the safety nets are so bare, and you don't hear central banks talking about that too much. They more talk about the drowning in honey. But if there is a recession, we're not going to be able to cut rates, and fiscal policies are challenged.
Jin, put the sovereign fiscal stuff to one side. Are you worried about corporate America's balance sheet? Is it too fragile? Do you think that if we do have some kind of an earnings shock, which might be nice if some of the GDP, a bit more of the GDP started going back to labor rather than just accruing to capital, if the earnings started going down, if corporate earnings started going down and actual wages started going up, is there a fragility in the sort of national balance sheet there which could be quite dangerous?
I mean, I guess I'm more of the position of feeling frustrated at how much is going into stock buybacks and dividends, and I've been attending some of the sessions that a group of CEOs and McKinsey and Larry Fink and Mark Wiseman have been hosting on kind of the quarterly capitalism, the long-termism, and whether is what we're seeing kind of a lack of opportunity? Is it more people just taking the easy way out and impressing their shareholders and investors, and there's not enough reward for investing in the long term? I mean, what's frustrating to me when I was in the government was, we very much wanted to fix our corporate tax system and lower rates and have a minimum tax and let people be able to take money back and forth. And people would come in and say, no, can we just do a repatriation holiday? Because we're going to invest in jobs. And then you say, well, okay, let's talk about that. What kind of measures could we use? And every single time, there was no discussion. Nobody wanted any measures or metrics or any baselines. And if you pulled somebody aside, they simply wanted to be able to repatriate to buy back shares as opposed to borrow to buy back shares. And I no matter how much I was beaten about the face and head for taking the position that we were at, I did not feel it was responsible for the U.S. government to go forward with another repatriation holiday, when not only was there no evidence from the last time that it led to more investment, but if anybody stepped to the side and had a candid conversation with you, they were very explicit. They wanted to do buybacks. So I guess I'm much less worried about their debt and much more worried about why there is a lack of desire to put that cash on the balance sheet to productive use. And is that a problem in the U.S.? Is that like a lack of opportunity in the U.S. economy? Is that quarterly capitalism trumping, investing in the long term? I think I think that's more where my worries would be.
Andrew, I believe those are questions for you.
Okay.
Answer them.
I think that, the corporate balance sheets are, again, we're late cycle, so they're stretched a little bit, but I think they're in much better shape than they typically would be at this point in a cycle. I do worry about, sort of counter a little bit to Noriel, that, every time the Fed has raised rates, no matter, and this time it's definitely been signaled better than ever in the past, but every time they raise rates, there's always volatility. We're starting to see that a little bit now because people are starting to get nervous about how they're going to do it, when they're going to do it. And I worry that when they do start to raise rates, people on the buy side in the bond market tend to take a pause, sort of see where it's going to go, and that generally starts to create a little illiquidity. I think that the corporate market's probably better prepared for that in the past with, the not having a maturity wall, with having good interest coverage. But you will start to see default rates go up then. I think you will start to see, some distress at that point.
And to Gene's question, is there any indication that the corporates are using their healthy balance sheets to actually invest in productive purposes, or are they using it for stock buybacks?
Well, the stock buybacks are much, much bigger than they've ever been in the past. So I think, if you look at the S&P 500, something like 95% of the net income is being used for stock buybacks and dividends. Dividends are actually pretty low relative historically and have sort of stayed where they've been, but the buyback part is higher. Now, you could argue that in terms of a flexibility part is better because it's easier to cut back on stock buybacks in times of distress than to cut back your dividend. People don't generally like to cut back the dividend.
Okay,
let me just make a quick comment on cash and stock buybacks. We've talked a lot about the juicing of the markets and asset prices as a result of low rates. I love Noriel's early comment. He referred to them as policy rates. Remember, these aren't market rates. These are policy rates put forth to encourage a certain type of behavior. The question is, who's benefiting from these rates? We're certainly seeing institutional investors, pension funds, corporations benefiting from these very low rates. That's not passing through. You made a very sly comment earlier. You sort of brushed over it when you said it'd be nice to see some of that GDP go down to wages. I think you were sort of worried that this audience of business owners may throw something at you if you really said that forcefully. But I think one of the concerns I don't believe that corporate balance sheets are over-levered at all. I do believe that they're pretty much out of dry powder. We've got historically low rates. We've seen refinancing take advantage of those rates. We've got wages as a percentage of revenues at all-time lows, 80, 90-year lows, the amount that's actually going to the bottom line. So efficiency has worked for the average corporation. They've efficiency, they've downsized. We look at the merger between Heinz and, or the proposed merger between Heinz and Kraft. I'd love to think that they're getting together to make, single serving macaroni, cheese, and ketchup, which I would love particularly. But that's really not the purpose there. It's to, again, create more efficiency. We've got whole layers of middle management that can be downsized. So the question is, how many bullets do they have left to drive up values? Revenues are not rising. Earnings are doing okay, but revenues are not rising. So you've got flat revenues, you've got rising earnings, but as a result of all of these other factors, what else is out there? The question when we talk about disequilibrium is, who's really benefiting from these policies?
Thank you for answering the question of what disequilibrium means. I think that's absolutely right. The disequilibrium is between labor and capital. But I have a question here from Chris Milner. Thank you all, by the way. Just a reminder, felix@fusion.net. Email in your questions. It's much more efficient that way. And I'm going to put this one to Damien. Gene was talking about a bunch of sort of, call them contingent liabilities or actual liabilities which aren't sitting on the balance sheet in terms of maintenance, infrastructure maintenance costs that we're going to have to pay at some point. Chris Milner is talking about the really big liability, which is the defined benefit pensions. And he says, aren't these defined benefit pension liabilities also debt? And if so, this is a good question. Isn't QE increasing pension indebtedness, especially in European corporates and sovereigns, and hence increasing basically the default risk to individuals, to the people who've been promised a certain pension once they retire?
Big question. So in terms of the defined benefit funds, there is this irony where the cheap money, the stimulus is pushing up asset prices, but most of these funds have got liabilities which have gone up even faster. So, and I guess how they're going to match those things in the long run is a bit of a challenge there. So, we're in a bit of the same position there, where you get these strong returns, but you wonder what's going to happen going forward. And I think that to me, this stability of the system is the risk that if we don't make those tough decisions, which are probably going to mean everyone has a little bit less pie. But unless we make those tough decisions and work out, well, we've got to spend this much on roads, like the Suns, you can't just be a consumer. You've got to get things to add up at the end of the day there. Otherwise, it won't work. And the same is true for the government or the pension liabilities. You just got to work out what you can afford. So, I mean, on a slightly different thing, we've started talking about not the liabilities of our members, because our members are defined contribution, but we've started talking about the goals. So it might be the case that we've got assets that are here and liabilities or goals that are here. If that's just not going to work, you're going to have to reevaluate some things. And I think that's possibly going to have to be the case in a lot of the pensions. If there's just not the money to be there, people are going to have to reevaluate what they actually can pay.
Do you think that in your view, Nouriel, would that be a form of default if we basically don't give people the defined benefits that they've been promised?
Well, I think that increasingly, probably both in the US but also in Europe, at least private pension funds are going to move away from defined benefits to defined contributions if you have a problem. And that's a trend that is going there. You'll have to negotiate it with unions and so on. But I would say that this redistribution of income that is occurring from savers and creditors to debtors and borrowers in some sense is necessary, because in a world in which there is too much debt and you have to ask yourself how you deleverage, there's no easy solution. The first one will be, of course, say lots of economic growth. Debt to GDP depends as much on the denominator as the numerator, but we're not going to have a lot of growth for lots of reasons. So that's not the solution. The second solution, that is thrift, save, spend less and save more, works at the individual level, but in the aggregate level, you have the paradox of thrift, of Keynes, right? That you are essentially, everybody spends less, saves more, we go in a recession, output falls, and the debt ratio goes higher. So that doesn't work. So what do we have to do? We have to redistribute essentially income and wealth from creditors and savers to debtors and borrowers to allow these people to start to spend again. Some people say, let's do something radical, debt default and restructuring. That's costly. Some other people say, let's have massive amount of inflation to wipe up the real value of the debt. Some people say massive capital levy on the rich and on capital and on the wealthy. Some people say financial repression. Now, all these things redistribute, but do it in a way that is very damaging. If you think about debt monetization, Yes, you're reducing the return for savers, you're reducing the debt servicing payments for the borrowers, but it's a transformation and redistribution that is more gradual, that leads to the same adjustment, but in a way that is less bumpy. So people complain that the savers are going to get a lower return. That's a problem, but the way savers and creditors get the asset reflation coming from QE. So net, actually, they're still doing better off. So when we ask ourselves, is that monetization a solution or not, the question is, may not be first best, but there is no first best policy, and the alternatives of default, inflation, expropriation, capital levy, wealth taxation are much worse. That's why the path of least resistance in US, in Europe, in Japan has been QE, debt monetization, and doing a gradual transition. That's the world we live in. And savers are hurt.
Peter, you would rather just have a wealth tax, right?
Oh, not at all. Absolutely not. Remember, I talked about productive and consumptive uses of capital, debt, whatever you want to call it. That's just the opposite of it. If you look at banks' balance sheets, there's $1 trillion more on banks' balance sheets of government securities right now than there was 5 years ago. That's $1 trillion. Why isn't that capital being used in productive purposes in our economy? Why is that just sitting there? One of the reasons it's sitting there is because it's very profitable. It seems counterintuitive, but a bank who can borrow it 20 times, it's still very profitable to hold treasuries. You can do that very profitably. But why isn't that being put out into our economy? Again, this goes back to policy. Unfortunately, it comes back to leadership, and we know where that stands in Washington. There's just no policy in place that is encouraging again, I'm not talking about redistribution, I'm talking about productive use of capital. Banks doing their jobs historically. We look at banks' earnings come this quarter. No one talks about lending. They talk about trading, revenues, and everything that a bank really doesn't do, or a typical bank should not be doing. They need to do more, but again, it starts with our policy and the encouragement of that movement of capital in our economy, not redistribution at all.
I'm gonna broaden this out now because it's about time that we started talking about non-American or non-European economies. A couple. Oh.
Can I ask a question?
Gene, ask a question. I have questions here, but you can ask a question too.
I don't know the answer to this, but I wonder. And it's a disequilibrium question, which is, it is said that 3/4 of private and bank debt in emerging markets is in dollars. And so my question is to those like Nouriel or yourself or others who are more adept at this is how much, when you're looking at a debt disequilibrium, are you worried that the strengthening dollar puts pressure not on the emerging market governments, but on their private sector and banks who are borrowing in dollars so much?
Which is related to the question which we got from Matthew Jacobs, who said we've started seeing defaults from Chinese state-sponsored companies. Like, is there a problem here? QE and monetization, all of that. What are the trickle effects in China, India, Brazil, etc.?
Well, of course, people are worried that right now you have $6 to $9 trillion of dollar debt in emerging markets, that they fall in their value of their currency. With the strength of the dollar, it's going to increase the real value in local currency of those debts. And as the Fed exits interest rates and interest rates go higher in emerging market, a lot of this stress is going to occur. You have to worry about this stuff, but again, I think you have to be a little bit more nuanced than that. First of all, compared to 10, 15 years ago when you had this sovereign corporate banking crisis in emerging markets, these countries have flexible exchange rates. So you don't have this sitting index of fixed exchange rates that collapse, the currency falls 50% overnight, and the real value of your debt goes up by 50%. It's a gradual adjustment. Secondly, compared to 10, 15 years ago, they're sitting on trillions of dollars of foreign reserves. That is a shield runs against your currency, against government debt, against your banks. That's another layer. Three, many of these countries are less dollarized than they were 10, 15 years ago. More of the debt is in domestic currency rather than foreign, and therefore the impact of a currency weakness is less. Four, their banking system have more liquidity, more capital. They've been supervised, regulated better. And finally, I would say that while debt ratios are rising, they're rising from low levels, both for the private and public sector, with a few exceptions. Therefore, the risk of solvency, in addition to the risk of illiquidity, is moderate. Now, there are pockets of risk in some countries, in some government, in some sectors of the economy, like the financial sector or corporate, in some of these emerging markets. But I would add the following point. Some of these problems are not because the Fed is going to exit zero policy rate, the dollar becomes stronger. Russia is a problem because they started a war in Ukraine, oil prices have collapsed, so it's idiosyncratic to Russia. Ukraine might have to default on its public debt, but because there has been a war, they're losing 20% of their GDP and they're insolvent. Brazil has done macro mismanagement. They're complaining about QE when you had QE, they're complaining about tapering when it was tapering. The problem of Brazil are not because of the Fed, they're because if you have macro monetary and fiscal mismanagement, of course you're going to get in trouble, and so on and so on. So in many of these emerging markets, whether it's Argentina, Venezuela, Brazil, Russia, Ukraine, or even Turkey, is not the Fed is going to cause the problem. There'll be specific economic policy of those countries that can lead to financial distress, but is idiosyncratic to the policies of that country. Those that have better macroeconomic policy will be able to adjust to a Fed normalization better.
Wow, that's the most sanguine I've ever heard Nouriel. He seems positively cool with what's going on in the world.
He also did a 7-point answer without taking a breath, and no pause or ahs or anything.
You have to be nuanced and generalized.
There is another disequilibrium which was brought to my attention by Gachao Kuna, if that's how I pronounce it right. Thank you for emailing me, Felix@fusion.net. We actually have a case where there's not enough debt, where we have under-leveraged place in the world. Here we go. In Africa, corporate debt as a percentage of GDP is in the single digits, and it has high yields. Isn't there some way of bringing some of this excess liquidity to where it could actually be put to good use, Damien?
Socialise the losses. So I think that, I guess from my perspective, it's largely a global economy. So you've had, for example, China pegged its currency to the US. What happens there is you largely import the monetary policy of that country if you do that. If the US does QE and then sort of gets benefits, maybe its currency falls, other countries, other economies such as Europe have got to do QE in order so that they can compete. So you get stimulus fighting with stimulus. So it may not be currency wars exactly, but you get stimulus wars. And I think that all of that has led to the issues where we've got. So when the housing bubble collapsed, there were stories. There were people saying, we need another bubble to help sort of to reflate things or to get money back into the system. So arguably, that's if there's Africa's a bit of a solution. There would be, well, how do we get them to leverage up, and then they can bring in more debt, which can help sort of bail us out a bit, essentially. Now, hopefully, it goes to some good purpose. There's lots that needs to be done over there, but a global economy, I'd say.
Yeah, I think a lot of people are reluctant to invest in Africa because the rule of law in some of the various countries isn't perfect, and people worry about getting their investments expropriated or investing a huge amount of money in building a mine for 10 years, and then the government, at the end deciding instead of a 10% royalty rate, it's a 50% royalty rate. So I think you see a lot of that. But I think as the country's governance has improved over time, I think you're starting to see that improve.
Do you have any particular countries in mind?
Well, I think people are very comfortable investing in South Africa, for instance. That's a place that where a lot of people are very comfortable. I think one other point to add to make Nouriel's an 8-point.
For those counting along.
In terms of the strong dollar maybe not affecting people as much as you think, is a lot of countries are resource commodity based. Now, obviously, commodities are terrible right now, but as their revenues are generally in dollars. So it doesn't matter sort of where the dollar's going, but as the dollar goes up, their local currencies go down, their costs go down in dollar terms. So actually it's a positive for a lot of the companies that are resource-based in some of these countries outside the US.
Negative rates. So we have $5 trillion-ish of bonds with negative interest rates, which is conceptually really hard to sort of get your brain around. And I got an email here from Ignacio Cerezo saying, this is theft. we have not heard about this, the financial repression. This is the biggest tax of all. How can we withstand these negative rates? Is this true? Is zero more than just a number? Like, does it, I mean, is the difference between minus 0.2% and 0.2% massively, importantly more different than the difference between 1.8% and 2.2%? Is there something? Well, tell me about this zero bound and what it means that we've started breaching it to the tune of trillions of dollars. David.
So I guess, and probably like, if I can just step back to something that Muriel said, which I think is incredibly important in terms of where we are, in terms of the decisions that we've got to make. And that really is where QE and monetization of debt actually fixes things up. And it comes back to these negative rates. So I'll link that back there. But let's say that before you did QE and stimulus, you had some liabilities that were here and you had some assets that were here. So you're underwater. Like if things like, normally you just default and you sort of move on type thing. But you have stimulus and you have QE and that pushes the price of those assets up there. So you're bailed out. And so that sort of helps out. Again, that's assets and liabilities. Compared to income, you push the price of the assets up compared to the income there. So now you've got a choice. If you're in Germany or the US there, you've got a choice in investing in equities. Now, price to trend earnings ratios, we've heard in the US there, have only been higher twice in the last 50 years. So we're looking at similar sorts of levels there in the US, Germany, Japan there. So you talked about market prices before. Those negative interest rates are market prices. Maybe that's the market saying, like, we are concerned about that there is a disequilibrium there. Like, so that path that Nouriel talked about, that's fine if the asset prices stay there. If they fall down, then that's a big risk. So I think that there is a disequilibrium. There's a risk associated with the QE pushing up those asset prices. And I think maybe what you're seeing is those negative yields reflecting that people are saying, well, do I want to have my money in a bank? Well, I'll pay a little bit to have it in a government security.
And I would point out that, it's not theft by the borrowers. That almost no one is, certainly no one outside of a handful of sovereigns is actually borrowing at negative rates. This is entirely a secondary market phenomenon that, bond investors are trading these things to each other at negative rates. And look, if that's what they want to do, this is what bond traders do. They trade them because they think they're going up in price.
Well, it's affected in part by government behavior because once overnight rates are negative, like in Eurozone, in Switzerland, in Denmark, in Sweden, and are expected to be negative for the next 3-4 years, you use the expectation hypothesis for pricing the bonds. Of course, you'll have 2-year, 3-year, 4-year yields also going negative. And if you are in places where your currency is expected actually to appreciate, like Sweden, potentially Denmark and Sweden, even if you're holding a 10-year bond, like in Switzerland, minus 50, first of all, is less than minus 75 on the overnight rate. And if you expect appreciation, the capital gain on that one is going to be more than whatever you get from those negative. And on a mark-to-market basis, even if the yields are negative, if you expect to become more negative, of course, you get the mark-to-market gain, even if, of course, at maturity, you're going to make a loss. So there's a whole slew of reasons why actually those long-term rates being negative are affected by policy decision and are likely to stay negative for quite a long time.
So Nouriel, you've done quite a good job with your many pointed answers about explaining why QE is sort of the least bad way of deleveraging. Can you just talk a little bit about the question of, if you're a central banker, QE versus negative rates? We had a long period there where rates would go down to zero and then you do QE. And now we seem to be entering this new world of doing negative rates either as well as or instead of QE.
Well, I would say that some of the central banks decided not to go into negative policy rates for different reasons. The Fed decided not to do so because they were worried about the money market funds essentially breaking the back and having net asset values below parity. That was the Fed argument. The Bank of England made a different argument that given the way things are set in the UK, the building societies could be stressed. I was in Japan and asked the BOJ why you have gone into QE as opposed to negative policy rates. Their arguments were two. One was that they were worried that the net interest margin of the banks will be squeezed and you'll have a credit contraction. Two, they were worried about the interbank market being destroyed. In the case of the Eurozone, instead, we got to the point in which we're the first episode in which we're having in Europe, but also in Sweden, not just the Eurozone, a combination of quantitative easing and negative policy rates. And I think we got there because in Europe we were outright deflation risk, and that combination of policy became more impactful in terms of credit easing, in terms of weakening the currency and jump-starting economic growth. So used to be either quantitative easing or negative policy rates. Now we have several examples in which both of them are happening, and they become probably more effective than doing one or the other, while the concerns that you have about money markets in the case of the Eurozone are less relevant.
Peter.
I'm just fascinated by the whole concept. It makes no sense to me. It's, but I am curious. You said something about squeezing net interest margins, but the banks, et cetera. This whole construct was to if it's prevent that. I'm just curious as from a policy perspective, why haven't they raised rates? Because what I see is a couple. First of all, if you remember, it was first about unemployment. When we get down to 8%, we're raising. Now let's make that 7. Now let's make that 6. We're at 5.5, which is a nonsense number to begin with. The unemployment rate is not at 5.5%, but regardless of that, you've also got banks who are enjoying all-time profitability from both a real dollar perspective and from a margin perspective. When is enough enough?
Gene, I'm going to put this one to you. Are we just conducting both fiscal and monetary policy for the sake of the banks at this point?
No, I think that Chairwoman Yellen, et cetera, is looking. I think if you look at what she said in her Jackson Hole speech in August, she's looking at unprecedented scarring in the labor force, long-term employment, length of unemployment at extremely high levels. And she is asking, is this structural or cyclical? And she's saying to the degree it's cyclical, knowing that when a person becomes long-term unemployed or stays out of the job market too long, that's a harm you can't take back, that she's going to keep pushing as long as she thinks there's a positive cyclical effect. If she gets to the point where she just thinks there's nothing more I can do, it's all structural, it's all training, et cetera. But if you even look at a little bit of what John Williams said in an article he wrote last year at the Fed, he says, when you have this kind of long-term unemployment, there's actually a case for are people dropping out of the labor force and employers discriminating against people who've been out of the labor force. A little bit of above 2% is actually a positive if it lures people in, if it makes employers give less attractive employees who've dropped out of labor force a chance. So I think that she has. I think they're looking really seriously at it. And I think when they saw the tremendous growth, not just in the 300,000 a month job growth in the fall, they saw a real significant decrease in long-term unemployment in U6 and involuntary unemployment. They said, wow, if this continues, we may hit that level. And I think that's why they made a few more hawkish noises. But still know that underneath the surface, those numbers have improved dramatically, but they're still not that great. Involuntary unemployment, which they talk about all the time, because I think they think that's both a measure of both sides, of full employment, but it's also a measure of how much slack's in the labor force. If you have people working 20 hours who want to work 40 hours, you don't really have to pay them more to do that. They say thank you. It's at 6.7 million. Now, until the financial crisis, it had never been over 7 million, ever. And it was around 8.5 million for 4 or 5 years in a row. The average length of unemployment now is about 30 weeks. The highest in history before that was 21.3 weeks in 1 month in 1983. So I think Janet Yellen believes in the hysteresis thesis. She cares deeply about not just the top rate, but what's really happening. And so I think that she's looking. I think she's being practical and was thinking if things continue to get better, you might hit that structural wall. And my guess is now, with the impacts of the dollar, rising dollar being greater than they thought, with a little uncertainty on the consumer spending side and a little less so that, but this latest job number, I think they're, I think they're more likely to be later, but I still think they're looking at the labor market, and I think they have good reasons to.
Yeah, I need a quick follow-up because it's interesting. It's a great discussion of it. I think one of the problems is we're not hearing that. We're hearing that our policies worked because the stock market's at an all-time high and because unemployment's at 5.5%. I think that's the conversation that comes out rather than a more nuanced discussion of we still have problems. And again, it's a question of leadership and frankly, facing the music to say we're not out of the woods yet from an employment perspective. But so much of what goes on in Washington is to try to prove, hey, I did the right thing. Look at how great the economy is chugging along because the stock market's at an all-time high. Two different things. Stock market is not the economy.
Yeah, if you could elaborate, in June of 2004, when the Fed started to hike, the U6 definition of unemployment rate was 9.4. Right now it's still 11, and that includes both discouraged workers, long-term unemployed, and part-time workers who want to work full-time. So there is a huge slack still in the labor market, and the fact that we're at 5.5 and wage inflation is still 2% is exactly what Janet Yellen says. The U6 tells you there is still a huge slack in the labor market. We have to shrink it before we start tightening. Otherwise, we'll make a mistake.
And is there, what hope is there that leverage, debt, loose monetary policy, all of these tools are actually going to be able to achieve that goal? Can we actually improve the employment situation by using these sort of monetary policy tools?
I think it's inferior. It's inferior to good fiscal policy, and it creates these risks. Yeah. And having had the joy of being National Economic Advisor when there was 4% unemployment, let me tell you, there is nothing like a tight labor market. Yeah. All the policies in the world, you have hotels that were coming to us saying, can we work with you on training people coming out of prison? We had 2 million, we had people agree to hire 2 million people off welfare. I mean, there was some goodness of your heart, but 4% unemployment. So for those of us who push on the infrastructure side and would prefer the fiscal side, it is a little bit of a belief that a tighter labor market would be helpful in reducing the hysteresis or long-term effect of long-term unemployment and would be the pressure on wages. And the United States government is, if you're grading on a curve, is an A+ on fiscal policy because of the stimulus, but only if you're grading on a curve. I mean, compared to Germany, everybody's an A+. But we got stimulus fatigue, and now we've put our central bankers in a position where they're not the lenders of last resort, they're the saviors, and they feel they have no choice but to use every bullet they have. But we should recognize that's in the face of a failure of fiscal policy.
Can I ask Jean a question there? So I guess, in my mind, if we're going to come up with a plan B, which isn't just more stimulus, it's got to be a big picture solution. And I think that I've heard, for example, things like QE and monetary policy described as the anesthetic without the operation. And I guess, in terms of that better fiscal policy that you see there, like one of the things that it seems like is because the central banks keep stepping in, people look at GDP and the stock market and go, oh, that's not really a problem, we don't have to do anything. Obviously the central banks are doing what they are asked to do in their mandate, but is it the case that maybe that mandate needs to change a bit if you're going to get, or is there a complication there?
Gene, you have 50 seconds.
Yeah, I could do a whole session on the challenges of Keynesian economics with the public and how difficult it is when you've done a lot and they think they're tightening their belt. Why isn't the government? You need to do more, but people think you've done a lot and things aren't great. I think there's a lot of difficulties, but I don't think that the problem is that everybody's going, well, the Fed's taking care of it. I think it's much more of a, I think we did have a huge run up in our deficit and debt, and that was an issue. But I guess since I can't say everything I want, I'll go back to the initial issue, which is we have a difficulty politically in doing kind of a compact where you agree at one time to stimulate when you need to, but in the same package show that you're going to deal with your long-term debt. And some of that, maybe just some justification that people believe that you'll do the candy and that you'll never do the vegetables. But I will tell you, in the United States case, when members of Congress vote for very difficult things, like the 1983 Social Security Act, when they've made that difficult vote, they actually do tend to stay with it. And I think that, I think what I would have liked more in my time there is if we could have figured out a way not just to debate entitlements versus taxing the well-off. That was kind of a balance in fiscal pain. But we probably were never successful, and Europe certainly is completely unsuccessful, in having a balance of combining upfront demand with comfort that you're going to deal with your long-term structural issues.
Now that is a conversation.
Yeah, that would be good.
You've heard this statement, I think, at every single Milken conference for the past decade. And we'll hear it for the next decade. But thank you very much for being a great
not for me.
panel. Not from me. From Peter and Damien and Muriel and Jean and Andrew. Thank you very much.